Hey everyone, it's John. It's time for a general market update. It's March 2nd, 2023. This is being recorded Thursday at approximately 11:30, and I believe the NASDAQ is testing support and down 0.5%. So first of all, I wanted to thank everybody for the well wishes after my surgery. Everything is gone well, and I'm glad to be back. So let's get into it. Again, presentations made by Rain King LLC for education purposes, and I'm an amateur growth stock investor. So the agenda today is to talk a little bit further about market sentiment. Then we're going to talk about trends. And then we're going to look at the pullback in the indices to monitor what we're currently seeing about the pullback. And then we'll try to summarize. We're clearly at an inflection point. I'm going to share information that you could look at things bearishly as well as you could look at things bullishly. So this is a weekly chart of the NASDAQ as of yesterday. You'll notice that we did get a strong push at the beginning of the year where we had multiple blue weeks up, which is really encouraging. And so far, the down weeks on a weekly basis have been in declining volume. That's good. We talked about the psychological 10,000 area as a bottom. It seems to be holding for the time being. Now, market sentiment. Talked about the AAII survey 2 weeks ago. I just wanted to share something interesting, the way this works. We mentioned that retail investors, the crowd, were starting to get bullish right around February 8th. You'll notice February 8th is right when the pullback started. Retail traders tend to be late. Now, in the 2 weeks that we've had this pullback, you'll notice that the bearish part of the survey has shrunken dramatically back to 21%. It's actually the lowest bullish reading of 2023. So now we have retail traders in the pullback, climbing back into their shell. It's just trying to point out that if you're following the news, you're going to be late. You need to be an independent thinker and do your own evaluation of the market and make your own decisions. Shared this last time. February can be kind of treacherous in the last 2 weeks of the month, and we certainly experienced this year because we had a strong January. Now, this is interesting. This is from Bank of America, Global Fund Managers. And I shared this because the question they were asked is, do you believe the rally that started in late September, mid-October is a bear market rally, or are we in a new bull market? You can see there's still a dominance of global fund managers that think this is a bear market rally. I imagine they think we're going to roll over to new lows. So there's plenty of uncertainty still within the institutional world about what's going to happen next and how do they position their exposures. Let's move on to trends, talk a little bit about trends and the importance of. If we looked at a seesaw as an analogy, it's bulls on one side of the seesaw and bears on the other. When you get a balanced state, things are kind of equal. This can actually result in sideways markets or choppy markets, not great for trend following. What we really like to see is we want to see the seesaw dominated by bulls. There'll always be a few bears, but if we can get a preponderance of bulls, we get an uptrend. And hopefully we get a smooth uptrend by more of the side on the bullish side. So very simple principle, but I want to try to relate this to what we're seeing today in the market. Now, there are uptrends and then there are uptrends. On the left, I've just taken a stock chart to share, an uptrend. So we see that this is fairly smooth uptrend. And what I mean by smooth is you'll see that the price spreads are fairly tight on the way up. You'll notice that each pullback is fairly brief. Look at these red bars, only 1 or 2 weekly bars. Pullbacks are brief. You'll see that we stay above all the key moving averages. And notice the relative strength line. Very few kind of kinks in the relative strength line. It's kind of climbing because we're in a very smooth, strong uptrend. Now, on the right, this can be still defined as an uptrend, but it certainly is very, very choppy. So back on the left, we have this situation where smooth uptrends are really when you have dominant bulls on one side of the seesaw. Over here, it's very uncertain. It's sloppy. You can see the price action as you have deep pullbacks. You have a few weeks up, you have multiple weeks down. It's choppy. Yes, there are higher lows in this uptrend, but it's certainly not an easy uptrend to trade. And you get this very, very choppy seesaw where sometimes some of the blocks are moving from red to green, green to red. They're very, very difficult environments. So I just called up a line chart of the NASDAQ and just drew a trend line. The downtrend that we've had in place for the bear market, we've broken through that and we've come back. So it appears as if the trend is trying to change. When you have a long grinding bear market, a sustained downtrend, there's a lot of gloomy news out there about the economy, rates, and the Fed, and you get these kind of day-to-day news-related swings. It can be very, very treacherous for a trend follower because we're in transition from a downtrend to potentially an uptrend. That's what we're hoping for. Now, what does the seesaw look like? Well, the seesaw is very uncertain. In these transitional periods, we've got blocks that might be bullish, things like the breadth thrusts, stocks above the 200-day, net new highs was looking good. But then we have bearish things too about the PCE report was very hot. People believing it's a bear market rally. There's recession worries, more Fed hikes. So day-to-day news is literally moving blocks back and forth on the seesaw. So there are up days and down days, very news-driven and very treacherous for a trend follower. So it makes it really challenging. And if you look at some of the long grinding bear markets of 2003 and 2009 and 1973, there's a period of transition to getting the trend into much more of a smoother state. Now, I've mentioned this before that it takes a lot of energy to turn an oil tanker. There are signs that the institutional tanker is turning and it's underway, but as I mentioned, it takes time and there's a lot of cross currents that are still dominating the news day to day. At some point, the market will not trade on news when we get a solid trend in place. Now, on the positive side, two ETFs, the S&P mid-cap ETF, MDY, as well as the Russell 2000 small cap index, we're seeing some good things. These are generally associated with a risk-on environment. And you'll notice that they've broken down trends and we're seeing a key thing. We're seeing higher lows. That's really positive. We're seeing higher lows here, though it's very, very gradual. The real question is, are we going to get higher highs? We have a high here that was made early in the year. We'd love to see the mid cap push forward and make a new high that would really help us understand that the trend is in place. And same thing, we want to see that with the small cap index. Are we going to get higher highs in place? It helps confirm that risk is coming back to the market. Let's get to the pullback and look at what we see with the current pullback. Last time we spoke, I said we were trying to understand if the market was pulling back gently, if it was kind of crouching before it's going to make another move higher, or is it really, really dropping sharply and it's like touching a hot stove? So where are we? Well, we're still following the Whaley breadth thrust signal that was given in the middle of January. The signpost that we've been using was the 6-week marker, which was at the end of February. So we're right at that place right now. And we said 3 to 5% pullbacks would be normal. So where are we? Here's the chart that I've been using and updating as we go along, setting up some expectations. There's the breadth thrust. We pushed above the downtrend line. We've come back with this pullback, and we are about a 6% pullback right at the juncture of key support levels of downtrend lines, the 200-day moving average. We're at a really, really critical state. It's important that this pullback does not continue further than the 6% to be considered normal. We are currently holding support. Our next signpost is another 6 weeks out, which will be April 15th, which I had shown the April marker would be stocks push higher into April up into the 4410 area. We'll have to see how that plays out. But a couple things have me on really a caution alert. One is, this is the New York Stock Exchange percent of stocks greater than their 200-day moving average. This was at a nice, solid, healthy 77%. In 3 weeks, this has really sharply declined to only 58% or slightly less. That's concerning how sharp that retraction is. That has me a little bit concerned. I have to keep an eye on it. And if we go to the NASDAQ, the other thing that has me concerned is this is looking at just the new lows each day on the NASDAQ. You know, as we started to rally, the new lows are drying up dramatically, which was great. But now the new lows are really coming in, above 75 to 130, and they're actually increasing on the pullback. So I don't like to see that. We're going to have to see if we can hold these critical areas, but it certainly is something that is worth monitoring carefully. Now, there is some good news, some bullish news related to the Whaley breath rust. Whaley himself, Wayne Whaley, put out this tweet last weekend. And he specifically, you can pause your video player to read it all, but the key thing is when you get a very strong January of plus 4% or more, and it's followed by a negative February, and he tabulated some statistics. When you have that situation, basically the period from March to August was 7-0, the market was up, and the average 6-month gain was almost 10%. So that's some bullish news. Even though we had a weak February, we had a strong January. We'll have to see how it plays out. The next piece of data is from Sentiment Trader. Their research shows that when the S&P 500 finally pushes above the 200-day moving average after a 20% or greater decline, there's some interesting statistics. We are currently 27 days above the 200-day moving average. In this situation, the market has never pulled back and made a new bear market low after staying above the 200-day moving average for a minimum of 18 days. You can stop your video player and see all the statistics and the go forward look. The previous record was 13 days above the 200-day in the 2002 bear market. What this is really saying is there's a high probability or high odds that the bear market low is in. Again, these are odds. It does not mean that we won't have a scary retest of the low. It doesn't mean we might not break the low, but the odds say that the low is in. So we want to always look at the next rally attempt to evaluate the market's health, particularly growth stock groups. Now, frankly, we really have had no real rally attempt. Intraday rallies have been rebuffed fairly quickly on news across the day. So when the market rallies and we get a legitimate push to really rally, we want to look under the surface. If we see the rally occurring in the indexes, but we get poor breadth in that decline line, I'd be concerned. If we see deteriorating new highs and increasing new lows, that would be a concern. It would be a bad sign that the rally is really faulty and weak. The other thing we do when we check the rally is we want to look at current leading stocks and leading groups. Now, I'm going to share with you one way that you can evaluate the leading groups on a pullback. And I'm going to use the semiconductors to conduct this. So I've done a very simple rate of change chart here using January 1st. And this is including a basket of the NASDAQ and a whole bunch of semiconductor stocks. You'll notice that all the semiconductor stocks are doing really, really well this year, but there still is the good and then there's the better. You'll notice I drew a line. The pullback that started on February 2nd started right here. This black line is the NASDAQ, which has been pulling back. We talked about that. But look how the semiconductors, almost every one of them, continued to go up for another week or so, even with the NASDAQ pulling in, showing the strength of the group. But we also know, look at the ones that are really the leaders. ACLS, NVIDIA, ALGM are clearly the leaders in the semiconductor group. There are others that are performing well, or they're not the leading ones in the group. So let's go one step further. Now I've just moved the chart to use the start date as February 2nd, which is the date that the pullback started. So you'll notice here is the pullback in the NASDAQ, the black line, it continues to go down. And you'll notice that the semiconductors since that time period, we're continuing to try and stay afloat and go up. They eventually got dragged down with the market. But what I've drawn this box around is really the last week. Look at the last week, how the leaders of the group have actually pushed higher. They're trying to get back to new highs. The weight of the market has held them down, and they're clearly showing you that they're really the leaders in the group. You can see that since the pullback started, NVIDIA, ACLs, and ALGM are all up between 7 and 9%. And look at the other semiconductors, they're up, but not as much as the leaders. So it's important to understand where the absolute strength is in the market. And this is one way you can do that. So evaluating this, kind of summarizing this, leading stocks on the indexes on the pullback, certainly the news, the CPI report and the PCE report have hit the market hard. We've taken some body blows the past few weeks. And the question is, how is the Fed going to react? Institutions are not sure, and certainly retail investors are not sure. Is the Fed going to wait to see the lag of their previous rate increases so they can get more information? Or are they going to get more aggressive about rate hikes again? Remains to be seen. Then it's all about trend. Do we have a trend? As we mentioned, when we talked about trend, the trend is in transition. It seems to be going from a downtrend to an uptrend, but it's sloppy. It's not clean. There are definitely some signs that the trend, breadth thrusts, new highs, new lows, are turning the corner, but it's going to take time. The percent of this pullback has really, really reached kind of the maximum to be considered normal. If we start breaking any further down to come 7, 8, 9%, this whole thing might roll over. So we have to be aware of that. The leading growth stocks, I think, have really become a mixed bag. I think the semis, the travel stocks, airlines, and gaming are still very strong and holding up well near highs. But some of the payment stocks, the builders, interest-sensitive stocks have really come under pressure with this pullback. And also, earning reaction gap ups have been very, very mixed. Some are working, others are failing fairly quickly. So it's a very important juncture for the market right now. I'd watch your risk levels, I'd watch your exposure levels to try and protect yourself and not get too exposed until we get more information. So I want to wrap up with the importance of trend, and the quote this week is from Frank Gretz of Wellington Shields. Stocks sell at fair value twice, once on the way up and once on the way down. Rest of the time, they're either overvalued or undervalued. The trick is to figure out the trend, which determines as much as 3/4 of the movement of individual stocks. The importance of this is we're really trying to see a strong trend develop. Market's at a critical juncture. We'll have to see how this plays out. Before we leave, I did want to share with you the latest piece of research that I've been conducting over the past year. It's called Earning Reaction Gaps, and it's a 300-page study that I'm completing that includes all the characteristics of the big winning gap ups, earnings reactions, and most importantly, it includes a half a dozen actual buying strategies of how you use the data from the study to trade. We're going to be offering a unique workshop on this, and the next general market update, I'm going to share with you 2 ways you could participate and join us for this paid workshop and get a copy of the study, which has over 85 annotated charts and examples of buy strategies, whether you're a day trader, a swing trader, or a position trader. Extremely excited about this, and probably in about a week, we'll have more information. I'm hoping that you'll want to participate. So that's all I have time for now. It's good to be back. Thank you. And this was the General Market Update for March 2nd, 2023.